It is my great pleasure now to introduce our guest today, a titan in the world of finance and philanthropy. David Rubenstein is the co-founder and co-chairman of the Carlyle Group, one of the world's largest and most successful private equity firms. With a career spanning decades, Mr. Rubenstein has been instrumental in shaping the landscape of global investment and has earned a reputation as a visionary leader. Beyond his remarkable achievements in business, David is also a dedicated philanthropist, supporting causes ranging from education and cultural preservation to public policy and medical research. His commitment to giving back is as profound as his impact on the financial sector. David, thanks again very much for being with us here today.
Clearly, the United States has caused some international uncertainty with respect to the tariffs. The tariffs were not expected to be anywhere as large as they now appear to be, and as a result, many countries are figuring out whether they're smart to negotiate a trade agreement with the United States or not. Beyond the tariffs, whatever happens on the tariffs, there is uncertainty about other issues in the United States and therefore around the world. I would say number one has been inflation over the last couple of years. While inflation is coming down, it hasn't yet gone down to the level that the United States government would like it to go down to, which is roughly 2%. Another issue that increasingly is getting attention and deserves attention is this. The United States is running roughly a $2 trillion annual deficit in its budget. And we now are approaching $38 to $39 trillion in annual debt. And when you have deficits that high and debt that high, it's not usually a good sign. Historically, if a country is paying more interest on its debt than it's paying on its military expenditures, that's usually not a good sign. And we're really near that crossover point in the United States. We're spending roughly $1 trillion a year in interest, and we're spending roughly $1 trillion, but not quite, on defense. The danger point for international investors relates to the dollar. If the U.S. dollar, which is the only reserve currency, were to be seen as not as stable or as likely to keep its value as it has over the last 10, 20, or 30 years, that could cause some concern. I do think that people in the United States are cognizant of that, and I do think, therefore, we're going to try to do what we can in the United States to make certain the dollar does not devalue. I do not believe there's any chance of a Plaza Accord as we had in 1985, when there was a systematic effort by the major trading partners to devalue the dollar. I don't think that's likely to happen. Donald Trump first came to public attention in the 1970s and 80s on international matters. It was his concern about the trade deficit that we then had with Japan, which was due to large automobile imports and electronic imports. And that really helped him get his public visibility to the point where he became better known. He's never really changed his view that the trade deficit is a major, major part of what our economy has to worry about. He seems to worry more about the trade deficit than the budget deficit at times, though I know he does care about the budget deficit as well. One of the reasons the president likes tariffs is that he thinks it will help reduce our trade deficit, which he's concerned about. He also thinks that it will produce more revenue for the United States, and he also thinks that in the end, it'll bring more manufacturing back to the United States. Whether all those objectives will be able to be achieved is unclear. But at the moment, I think the president sees his position as gaining strength for the U.S. economy because countries are coming and trying to negotiate trade deals. And he has, in order to get these trade deals done, he's been pushing back the tariff deadlines a number of times. I suspect you'll see more pushback as more trade deals are getting close to being done. But in the end, I don't think that the U.S. economy is going to be dramatically changed by the tariffs. I think it's very difficult to bring back all of the manufacturing that we've lost over the last 50 years or so back to the United States. We've become largely a service economy, and the overall deficit, when you take into account manufactured goods and services, is not as big as it is if you take into account only manufactured products. But I think the president likes the art of the deal. He's somebody who likes to negotiate, and he thinks he has people coming to him to negotiate. So I do think you'll see some transformation in the U.S. economy, but I don't think it's a deleterious one. And in the end, I think the numbers are likely to be much less in terms of the tariff rates than we've seen projected in the newspapers. So in the end, I think the tariffs will be tolerable. We're doing something that's unusual, which is we have a large economy, the largest economy in the world, and we're trying to bring jobs back to the United States and try to do things that normally large developed economies don't worry about as much. But President Trump is very serious about it, and I don't think we should ignore his views as being the U.S. government policy for the foreseeable future. Well, Americans, of course, will not say that there's a decline of American exceptionalism. I think Americans will have the view that we're still the greatest country in the face of the earth, the largest economy, the biggest technology, the biggest entrepreneurial spirit, the greatest, I would say, cultural institutions, universities, and so forth. However, there's no doubt a major shift is occurring, in my view, but shifts like this don't occur overnight. They take a period of time before they're felt. And I think the change that you're now seeing with respect to Europe is this. I think Europe realizes that when you have a president like Trump, and we might have other presidents like Trump, you cannot depend on the United States to do everything that it may have done in the past. So I think Europe is now increasingly interested in building up its defense industry, and I think you're going to see more defense manufacturing than you've seen in the past. Just to illustrate how serious the problem has been, right now, about 85% of the procurement of European governments in the defense area come from procurement made of United States products or technologies or weapons. In other words, when Europe increases its defense spending, very often, at least the procurement part of it, 85% of it is being expended in the United States. I think Europe doesn't want to be that dependent on the United States in the future. So I think you're going to see more and more European defense companies being built and more defense tech companies being started in Europe. America is going to be celebrating next year its 250th anniversary. And therefore, there's going to be a lot of pride in the country, and Americans will say, look how great our country has become. I think if Europe is united, Europe can become a much more significant global factor than it has been the last couple of years. Before the Great Recession of 07 and 08, the European GDP was roughly the same as the United States, even though the United States has many fewer people. Today, the United States GDP is much bigger than Europe's, and that's because the United States economy since the Great Recession, and particularly since COVID, has gone much greater than we would have expected. And therefore, I think Europe recognizes it's not in a position where it can get as much as what it wants from the United States as it did before, and it needs to be more self-reliant, not only with respect to defense, but with respect to energy as well. Europe was very dependent on Russian oil and gas, and I think, and also to some extent, on imports from the United States and other countries. I think Europe wants to be less dependent on Russia and needs to be less dependent on Russia and less dependent on the United States and to feel secure. And so I think Europe will spend more time developing renewable energy sources, nuclear energy sources, and also finding new sources of oil and gas and liquefied natural gas that it can import from new partners. The reason that people are interested in democratizing private equity is the theory is, why should wealthy institutional investors and high net worth people be the only people that get the benefits from the higher returns of private equity? And what that really is saying is that over the last 10 years, 20 years, 30 years or so, as the private equity industry has grown and matured, it has still outperformed public equities. I think that will continue because obviously there are a lot of smart people that go into private equity, but it'll change in many ways. Early on, private equity was mostly venture capital. Then it went to buyouts. Now private credit is actually bigger than private equity in many ways. And then real estate has become a very large part of the what I'll call private equity business or private investments. And I think that will continue. I think it's a general view in the United States now that it's unfair to let people who are just wealthy people get the benefits of private equity. And so we are beginning to democratize private equity by allowing 401ks and IRAs to get into private equity. Now, is that a problem? Last year, when the Magnificent Seven were at their peak, they were roughly 35% of the S&P 500. So if you're investing in an S&P 500 index, we are not really that diversified because 35% of the value of that S&P 500 index is really 7 companies. So I think that private equity is reasonably diversified, reasonably secure, and I think does give people a better chance to invest in something that is likely to get a better rate of return. All over the United States, we have a policy that to be investing in private equity, you usually have to be a accredited investor. So if your father is very wealthy and you are not that smart yourself, but your father gave you $100 million and you can do whatever you want, you dropped out of college, you can barely read and write, you can take that $100 million and do whatever you want. If you're very, very smart, your father gave you no money, and you went to college and came in first in your class, you majored in economics and finance, but you're doing something like Teach for America or a not-profit thing, you don't make much money, you're not considered an accredited investor because you don't have any money. You probably need the higher rates of return in your 401k to help you get a better retirement position. But under our system, you're not allowed to do that right now. That's changing because we recognize that we should democratize private equity so that everybody, rich or poor, have a chance to invest in the benefits of private equity. And it'll be changing all over the world as well. I think private equity has grown not because of the charm and good looks of the founders of these firms. Obviously, that's not been the reason they have grown. They've grown because smart people have concluded that the risk reward is actually there. And I do think that many smart banks and other kind of wealth providers and wealth managers have concluded in the last 10, 15, 20 years that if they can get access to the best private equity funds on behalf of their clients, they're going to do quite well. And generally that's the case. And I think Pictet has built a very good business doing that for its clients. And I think Pictet is one of the finest banks I've met and wealth managers in the world. I think that, people like Pictet, and particularly Pictet, have done a great job for people that don't have access to the best private equity funds, but want to get access, and they use Pictet to help get that access. So I think Pictet's done a good job for its clients.